Welcome to this video series about measuring value creation in private equity, where we talk about how growth in a company's addressable market and market share can drive private equity returns. My name is Mike Reiner, and I've worked in the industry for 15 years. I run the AUXILIA Mathematica website, and I wrote the book Private Equity Value Creation Analysis. These videos cover findings from my work, website, and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is video number 13 in the value creation series. Last time we showed you how to measure the forces behind multiple expansion, and now we will tackle revenue growth. The math is essentially the same, but it is often necessary to adjust the equations a bit so they work with real-world data. Here we start with the two revenue growth formulas that we described back in video VC113. The derivative model gives us revenue growth measured in dollars of absolute value creation, V, and it's equal to the change in revenue, delta R, times the average holding period EBITDA margin, EM, valuation multiple, M, equity ratio, ER, and fund ownership percentage, phi. The logarithmic model gives us multiple expansion as an equity return multiplier, chi, and this is simply the revenue at time 2 divided by the revenue at time 1. We showed in the last video in VC106 that we can convert back and forth between the V's and the chi's with the following math, and despite these formulas looking very different, they give the same answers, generally within 1%. Now, just like last time, we'll propose the existence of a market revenue, MR, which represents the revenue of the typical sector or industry peer. This will be used as a benchmark. We'll say that a company's revenue outperforms the market if it grows faster than peers, falls more slowly than peers, or gains revenue while the peers lose it. Likewise, we'll say that company revenue underperforms the market if it grows more slowly than peers, falls faster than peers, or loses revenue while peers gain it. To precisely quantify the impact on equity value creation, we define a new variable with the Greek letter rho. This is equal to the company's revenue divided by the market revenue at any time t, and it means that we can also represent the company's revenue as the product of market revenue and rho. Now, this relationship allows us to express the change in revenue delta R as the change in market revenue times the average rho plus the change in rho times the average market revenue. When we plug this into the derivative model for revenue growth, we get two new drivers of equity value creation. One is a market-driven value lever, and the other is a company-specific component. We get the same thing with the logarithmic model. The market-driven equity return multiplier is MR2 over MR1, and the company-specific equity return multiplier is ρ2 over ρ1. So this is mathematically correct, but the problem is that unlike market multiples that we saw in the last video, there's really no such thing as a market revenue. We could probably come up with a reasonable proxy by building a company-specific comp set for each deal, but that approach is not scalable, and it gives us numbers that are only really meaningful for one specific analysis. It's not something that GPs and LPs talk about, and unlike the ubiquitous market multiple, we don't have industry research firms and investment banks compiling those numbers into handy reports. The solution is to replace market revenue with a real number like a company's total addressable market. This can be calculated many different ways, so there may be some disagreement about the value, but at least it's a number that GPs and LPs are used to discussing. Almost every deal should have some estimate of the addressable market in the GP's investment memo. We start by defining the addressable market as AM. Now, instead of the Greek letter rho, we'll use MS for the company's market share. That's what you get when you divide the company's revenue by the addressable market. And this means that at any time t, we can represent the company's revenue as the product of its addressable market and its market share. Now we just repeat the math. We can express delta R as delta AM times the average MS plus delta MS times the average AM. When we plug this into the revenue growth formula, we get two new value drivers. Addressable market growth, representing broader market forces, and market share growth, representing the specific activities of the GP or management team. These two value drivers will always add up to the same number you get from the revenue growth formula you see up top. The logarithmic model also works as expected. The addressable market growth multiplier is AM2 over AM1, and the market share growth multiplier is MS2 over MS1. Now, these could be our final equations, but we often have a problem with AM1 and AM2. Measurements of the total dollar value of addressable market can be inconsistent and unreliable. There are many different ways to calculate them, and the numbers thrown around by GPs and investment bankers tend to be suspiciously rounded. They have lots of zeros and often start with numbers like 5, so 500 million or 50 billion. We really don't want to base our analyses on something that's so subjective. It makes our models harder to defend, and it's kind of an open invitation to nitpickers who might have different opinions about the addressable market and decide to make a bigger deal about it than is really warranted. I say that because our results are not driven by the absolute dollar value of the addressable market, but by how much it changes. An addressable market that goes from 500 to 600 million will give you the same exact result as one that goes from 50 to 60 billion. So if we adjust the formulas to run on relative changes rather than absolute values, we might avoid some unnecessary discussions, distractions, and perhaps some drama. Now, the way that I did it in the book is to define relative changes in the addressable market as beta and relative changes in market share as alpha. Beta is just the standard percent change formula, delta AM over AM1. This is the same as AM2 over AM1 minus 1, or the addressable market growth equity return multiplier minus 1. Alpha is the percent change of a percentage, delta MS over MS1, and this is the same as MS2 over MS1 minus 1, or the market share growth equity return multiplier minus 1. Now, in the domain of equity return multipliers, revenue growth is a product of the addressable market growth and market share growth, and we can replace the later two fractions with 1 plus beta and 1 plus alpha. This allows us to solve for alpha, which is R2 over R1 divided by 1 plus beta, then minus 1. And that's how we would typically do it. We pull the addressable market change from an industry report or economic data, and then use beta, R1, and R2 to calculate alpha. Now this makes our logarithmic model very simple. We just swap out the multipliers with 1 plus beta and 1 plus alpha, and we're done. Unfortunately, the derivative model is a little more complicated. In the book, I show that the addressable market part of revenue growth is equal to beta over 2 times the quantity R1 plus R2 over 1 plus beta. The market share part of revenue growth is equal to alpha over 2 times the quantity R1 plus R2 over 1 plus alpha. These two terms always add up to delta R, and when you plug them into the revenue growth formula, you get two new value drivers, one for addressable market growth and one for market share growth. I think these formulas highlight something that's kind of interesting. Back in the early videos, the derivative model of formulas for things like the leverage effect and EBITDA growth, they appear to be simpler and more intuitive than the logarithmic model. However, as we break these value drivers into smaller and smaller pieces, we see that the derivative model formulas get bigger and uglier. On the left side, we need information about the EBITDA margin, the valuation multiple, the equity ratio, the GP ownership percentages, in addition to revenues, alphas, and betas. But on the right side, we only need revenue, alpha, and beta to get an answer. The logarithmic model is often easier to work with as you go deeper into the value drivers because it maintains its general form. Okay, let us look at an example. Here's the same company where the GP gets a 2x return on a $44 million investment. And we propose that the EBITDA increase from 20 to 30 comes from growing revenue from 80 to 100 million while it expands its EBITDA margin from 25% to 30%. The first thing to do is to calculate all the deltas, averages, and multipliers as follows. And the math in VC113 tells us the $20 million revenue increase gives us fund level equity value creation of 14.14 million. Now let's assume that over the whole, the addressable market increases by 10%. This means we have a beta of 10% and an equity return multiplier of 1.10x. We can now calculate addressable market growth, take the R1, R2, and beta from the table, and plug them into the formula to provide addressable market growth of 6.04 million. Next, we calculate alpha. The highlighted numbers give us everything we need. We get an alpha of 13.4% and an equity return multiplier of 1.134x. Here we see that our alpha is bigger than our beta, so we should expect more market share growth than addressable market growth, and that's what happens. When we plug R1, R2, and alpha into the formula, we get addressable market growth of 8.10 million, and as expected, the 8.10 and the 6.04 add up to revenue growth of 14.14 million. All right, now let's try the logarithmic model. The important numbers are the change in GP equity value of 44 million, the GP's multiple of invested capital of 2.0x, and the equity return multiplier for whatever value driver we are measuring. The revenue growth equity return multiplier is 1.25x, so we take 44 million times log 1.25 over log 2 to get revenue growth of 14.16 million. The addressable market growth multiplier is 1.10x, so we take 44 million times log 1.1 over log 2 to get addressable market growth of 6.05 million. And the market share growth multiplier is 1.134x, so we take 44 million times log 1134 over log 2 to get addressable market growth of 8.11 million. These last two numbers do, in fact, add up to the total up top, and as promised, the derivative model and logarithmic model results are quite close. Here they are within only 20 basis points. Now, as usual, I went through the math quickly in this video, but you can see all the formulas on the episode page and download the Excel file, which allows you to enter your own numbers and tinker with the models and the charts. So that's the math. Let's talk about data sources and where we should find our betas or our addressable market numbers. I think there's two ways to look at this: third party and custom built. If you're a private equity GP, it's best to find respected third parties who compile the market proxies for you. Ultimately, numbers like beta or market multiples, they'll be considered part of your marketing materials, so your life will be easier when they are simple and non-controversial. It must be obvious that you're not just cherry-picking values to make your deals look good. You need to maintain some level of philosophical consistency where your analysis is easy to defend and simple enough to explain in a footnote that's only 1 or 2 sentences long. An example might look like this chart, which you can find for many industries. This estimates the addressable market size in dollars for each year. You can use these numbers to calculate your beta or even plug them directly into your model as AM1 or AM2. Just make sure you use data from a reputable research firm, and it's best if they update the reports relatively frequently. That way you can use the same addressable market datasets for future deals as you do for your historical deals. Now, quite often you won't get the addressable market in dollars for every quarter that you need, but the report will say something like, between the years 2010 and 2020, the medical device market grew at a compounded annual growth rate of 4%. We can also use this to calculate beta. It would be 1 plus the CAGR raised to the power of the holding period minus 1. If the deal in question was held for 3.5 years, you would get a beta of 14.71%. Now, the alternative is to build your own addressable market datasets. You might maintain a set of medical device numbers that look like this, or you might manage several datasets, one for each of your target industries. I think that this approach is particularly interesting for limited partners. You can build a handful of datasets like this and use them as standard benchmarks to evaluate all your private equity deals and managers. It's like PME, but it's better because 1, you have a ton of flexibility in tailoring the datasets to the markets or industries, sectors, or deals, and you don't have to worry about the different leverage levels between the private equity companies and the public companies. Our models correct for that automatically with the leverage effect and gearing value drivers that we discussed in VC107, 108, and 109. Now, in order to satisfy SEC marketing rules, GPs must put extra effort into justifying why an addressable market value is applicable to its deals. For the LP, it's just an internal benchmark, and they can really make it whatever they want. They might get numbers from one of the hundreds of market research firms out there, the Nielsens and Gartners and whatnot. They can also derive data from public comps. I would consider looking at total TTM revenue over time for a set of companies that are defined by either an index like the 10 or 15 software companies in the S&P 500, or a selection from algorithmic parameters that include things like company size metrics and industry codes. You can often generate these numbers quite easily just by clicking a few buttons if you have access to some of the commercial financial data providers that we mentioned last time, the Capital IQs, FactSets, Bloombergs, etc. And finally, you could build these from economic data, which is not only abundant, but typically free. If a GP is regionally focused, let's say they only invest in Brazil, for example, you might use the country's GDP as a proxy for the addressable market. That gives a GP credit for any growth that exceeds the country's overall economic trend. Or you can use something like the Consumer Price Index if that's a proxy that's important to your program. That would require deals to grow faster than inflation. In the book, I showed an example of using gross output by industry. This is publicly available data from the U.S. Bureau of Economic Analysis, and we use it to create a proxy for machinery manufacturing in the United States. When you combine something like this with a set of market multiples, you can create a very convenient and powerful benchmark of return expectations for deals that occur in that space. I call it a market return matrix and show you exactly how to set it up in chapter 12 of the book. This one is based on the machinery manufacturing numbers that we showed in the last shot and some middle market private equity multiples from a popular data provider. What this does is tell us how much of a deal's gross multiple of invested capital is driven by broader market forces based on various entry and exit dates. Let's consider a deal acquired in 2010 and then exited in 2014. Here at the intersection, we have a market-driven equity return multiplier of 1.81x. This is the number that any deal in the space must beat for the GP to claim any kind of financial, operational, or manager-driven equity value creation. If the deal is at 1.8x or lower, the entire return can be explained by the 28% increase in the addressable market and the 3 turns of multiple expansion that followed the Great Financial Crisis. Exactly how much of the equity return can be explained by these market movements can be measured with this relative value creation formula that we described in VC106. For example, if a deal has a gross return of 2x, you can take log 1.81 over log 2 to get 85.2%. This means that 85% of the return was driven by the market and only 15% was driven by the manager. However, if the deal has a 3x return, you can take log 0.181 over log 3 to get 53.8%. This means that about half of the equity return is driven by the market, while the other half is driven by the manager. Now, let's look at a deal that was acquired in 2012 and sold in 2016. Here at the intersection, we have a market-driven equity return multiplier of 0.84x. This says that a typical deal in the space would have lost money because the addressable market shrank by 13% and the market multiple contracted from 874 to 846x. In this case, even a GP that loses money might be credited with creating positive value as long as the return is better than 0.84x. We can see this play out in the relative value creation formula below. For a 2x deal, we get a market-driven return of minus 25%. And this means that 125% of the equity return came from financial, operational, or manager-driven initiatives. In fact, we might want to reframe the deal's return multiple to reflect this. Considering the GP generated a 2x return in a 0.84x environment, we can use this formula to show that the manager-driven return multiple is closer to 2.4x. So that's a quick overview of the market return matrix and how an LP in particular might use it. They are quite easy to build, and the next time you're sitting through a GP's annual meeting, you can use something like this to check those narratives and figure out exactly how much of each deal's return was driven by broader market forces. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.